What is up, my investing friends? We have seen some uncertainty in the market. We've seen some volatility. Perhaps the bull run that we've been experiencing is towards its end. And so, what we want to do now is we want to look at safety companies. So, when investors get a little nervous in the market, when things are at all time highs, when PE valuations are being stretched, sometimes investors want to look for not as much growth, but they want to look for safety. They want consistently awesome companies that are going to not only have a return on your investment, but they're going to give you some cash in your pocket with dividends. So, not all dividend companies are the same. As a matter of fact, we are going to look at what are called dividend aristocrats here. Dividend aristocrats are companies that have grown their dividends for 25 years or more. So this is not a full list, but this is a list of about eight or nine of my favorite dividend aristocrats out there. Okay, so we have Procter and Gamble, Johnson & Johnson, Target, Coca-Cola, Colgate, Automatic Data Processing, Walmart, Pepsi, and New Era Energies. So what we've done is we put these companies through our evaluation scoring process here at Interflame Investments, and we have their scores. So we want, well, if you recall, these scores range from -10 to +10. So -10 is complete garbage, don't even look at it. +10 is basically a perfect company in its sector. And we have all sorts of sectors here. What we are looking for is scores of 5 and higher. That gives us a starting point. That gives us a foundation saying these are in the upper 25% scoring companies that we're looking at. So we will be looking at these 6 companies in this video. We're going to look at Procter & Gamble, Johnson & Johnson, Target, Coca-Cola, Colgate, and ADP. Okay, so we can see their metrics here. If you've been following for a bit in recent videos, you know that I've been really into the forward PE 5-year. And what that means is, for example, if I buy Johnson & Johnson today, I'm currently paying a 19.31 price to earnings ratio. But at today's price, in 5 years, if the company grows as we expect it to, it's actually probably going to grow such that the PE that I'm getting today is going to be 10.53 in 5 years. Now remember, PE ratio, lower the better. And so that is basically cutting its PE ratio in half, going from 19 to 10. So the forward PE 5-year, becoming a favorite metric of ours on the channel, we can see that the price may be a little inflated, the valuations may be stretched, but if this company is going to grow, what is its PE going to be in 5 years, roughly, right? We can't predict everything perfectly, but we also have the PE ratio, debt to equity, return on invested capital. ADP and Colgate are absolutely killing it in that sense. We have return on assets, we have dividend yield, dividend growth, years of dividend growth, payout ratio, and free cash flow yield, in addition to the 5-year forward PE. So you can take a look at these numbers. You can compare them to what you think, what you pull out, but we can see that these companies that are ranking 5 and higher on our scoring system, fantastic companies. So now what we want to do is say, well, of those 6 companies, how much of our money should we put toward them if we wanted to invest in them? Now, normally at this point in the video, we would look at the growth scores as well, but I am not too terribly concerned about the growth of these companies. If they grow, fantastic, but I want to know what their safety is. I want to know, are these going to be consistent dividend payers, and are they going to grow those dividends over time? So I have put in no growth score for these companies, but I have put in their safety scores. Okay, therefore the average score is the safety score because there's nothing else to average it with. And I also have the intrinsic value of these companies. Now, how did I compute these intrinsic values? In other videos, which I will link down below in the comments or in the description of this video, we went through some intrinsic value calculators. So we went through a PE multiples calculator where we projected the earnings per share out 10 years into the future. We found the terminal value. We scaled that back into today's dollars, and we asked ourselves, is this company worth it? We can see that currently ADP is trading for 258. According to this model, it's worth 248. So it's about a 4% premium that you would be paying on ADP according to the PE's multiples ratio model. But in another video, also linked down in the description, we went through the dividend discount model. And in that model, we would find that actually ADP is Very, very high, right? The price is currently 258. Intrinsically, according to this model, it is 727. Okay, that's a 64.5 margin of safety. I would be a little skeptical of that number. Maybe my dividend growth rate's too high. Who knows? But one is way, way too high, or maybe not too high, but one is very high. One is kind of sort of low. And so what I'm going to do is average these two intrinsic values. And so that is how I get the intrinsic value for ADP. I average those two values together and I get an intrinsic value of $488. And that's what I did for Procter & Gamble, Johnson & Johnson, Coca-Cola, Colgate, and Target as well. So you can do the same thing. If you check out those videos, you can make your own versions of those intrinsic value calculators, and you can get a decent idea as to what these companies might be worth based on their price to earnings ratio and also their dividends that they offer. Okay. Now, we're also pulling the price of those companies and we're computing what is called the margin of safety. We want to make sure that, yeah, we think it's worth 153. It's currently trading for 140, but this 153 is a guess. It's an educated guess. It's an educated calculation, but we want to be sure. And so we compute the margin of safety. We typically like margins of safety above 20% on this channel. So really, if we were putting real money to this, we would probably only focus on Johnson & Johnson and ADP. Those are the only two companies with margins of safety above 20%. However, if you wanted to diversify, if you wanted to put some money into all these companies, how would you invest $100? That's the right-hand side of the spreadsheet. You'll notice that the margin of safety on Colgate is negative, meaning we are paying a premium for it. It's $77, but we think, according to our estimates, it's only worth $65. So we're going to put $0 into Colgate. Okay, but the rest of them, we're going to weight accordingly. We're going to click and drag this down, fill it out. And if we had to invest $100 into these six companies, we would put 12 into Procter & Gamble. We would put 36 into Johnson & Johnson, just one measly dollar into Coca-Cola, $11 into Target, and 40 into ADP. Of course, this is not investment advice. I'm not telling you to buy these companies. I'm not ever going to tell you to buy any companies in particular. This is for educational and entertainment purposes only. Okay? We can scale this. So if you had $1,000 to invest, we just put 1,000 in there, and you invest 119 into Procter & Gamble, $356 into Johnson & Johnson, etc. So this gives you an idea of how to invest in companies that might offer a little bit of safety in case the market sort of turns south for a little bit. If we enter into a recession, these are reliable companies that for 25 years or more, they've not only paid dividends, but they have grown their dividends as well. So I encourage you to like and subscribe to this channel if you have not done so already. If you got any value out of this, we're going to keep pumping out content, basically one per day, to analyze stocks and teach everybody how to value companies and get the most for your money that you invest, your hard-earned money. But also, I encourage you to check out all the Dividend Aristocrats. There's a list of them you can find online. Just Google it. And there are some interesting companies in there that might be hidden gems that will pay you passive income. You can use those dividends to pay for your phone bill, your electric bill, your water bill. Dividends can pay for your groceries. And if you play it right and you get your dividends to a certain level, they can actually pay for your entire lifestyle without ever selling a single share of stock. That's the dream. Earning enough in dividends to pay for all your bills, pay for your entire lifestyle, live comfortably, retire early, and live the good life. But in the meantime, you will be collecting dividends that you can reinvest, that you can spend however you'd like. Dividend Aristocrats would be a fantastic place to look. So again, like and subscribe if you have not done so already. Thank you for watching, and I'll see you in the next episode.